Okay, so this is totally insane since the dollar is dropping in value relative to every other currency in the world, including the Chinese yuan, which has just set a new record low versus the dollar, and the British pound, which is on the verge of collapsing. In reality, the current parity between the British pound and the US dollar is unprecedented. What does this mean then? If the dollar has become trendy again, then it's time for a magic act. And as of now, the dollar is currently at its highest value in the last 51 years, with the exception of 1971 and the mid 1980s. A higher dollar may seem like wonderful news at first, but it has serious consequences for the global economy and the stock market. The most crucial realization you must make at this time is that none of this is happening by chance. The central bank, often known as the Federal Reserve, is mostly responsible for this. And right now, the cost at which banks borrow money from each other, known as the federal funds rate, can be raised to achieve this. Now, without getting too technical, simply keep in mind that the bond interest rates and bond yields are influenced by interest rate at which we, as consumers, pay to borrow money. To sum up, rising interest rates from the central bank lead to higher borrowing costs but also to a decline in the bond market. It is plummeting, falling rapidly, because anytime prices fall, interest rates rise and yields increase. That's why moneyed individuals from every corner of the globe are eager to trade in their underperforming stocks, properties, and currencies for US dollars. And the fact that the majority of our bonds and assets are denominated in dollars helps explain the dollar's recent surge in value. And so, this is Investing Path, and we'll be explaining why and what is currently happening with the dollar's value in the market. In addition, we have recently uncovered some information that, when applied to the last time we were in this circumstance, provides a pretty good description of what the stock market will do. Now that we have that out of the way, make sure to give this video a like and subscribe. And if you already did, then let's dive in. There have been rate hikes not only in the United States, but all throughout the world. 10 countries have increased their rates by a combined total of 6% in just 1 week. Now the question is, if other nations are also rising their rates, and their bond interest rates are going up, why and how is the US profiting the most from this? Keep in mind that the reason that the central banks are all doing this is to fight inflation. Why wouldn't people in other countries choose to invest in their own bonds and stocks? No, they wouldn't do that, is the correct response. The reason for this is that people's expectations for the future of the global economy are not very optimistic at the moment. You may recall that we made a special note of the British pound and the Chinese yuan at the outset of the film. This is because both currencies play crucial roles in the global economy. However, their currencies are currently declining in value. In the case of China, the second largest economy in the world, the real estate market is creating a massive cloud that threatens the entire economy. The real estate sector accounts for 30% of their GDP and 50% of their investments. A drop in sales and prices would be devastating. With the zero-COVID policy still in place, their economy won't be able to recover unless the process is over. There hasn't been a collapse just yet, but that's exactly why the rest of the world is wary of China. Because of fear of collapse, number 1. The United Kingdom is the 5th largest economy in the world and is widely regarded as a secure financial center. Nonetheless, the British economy is currently precarious because the Bank of England has lately promised to purchase bonds in whatever scale is necessary to prevent a meltdown. They also recently presented a big tax cut and borrowing package. Their investors are fleeing the bond market and dumping their currency because they know that greater borrowing will lead to increased in spending, which will lead to increased inflation, which will lead to increased interest rates, which will lead to increased misery. All roads lead back to the US currency because of this. Obviously, these two factors aren't responsible for the dollar's strength on their own, but together, they create a magnetic energy force field that draws other currencies toward the dollar. Now that you know how the dollar operates and the reasoning behind it, we will explain why it's such a scary situation, especially for the stock market. Morgan Stanley determined that every time the dollar reached a peak, it was simultaneously followed by a terrible economic disaster, which would blow your mind. The dollar's peak coincided with every single bubble, recession, or crisis in history, which is a terrible thought. The dollar, however, is not to blame for these occurrences. In fact, the opposite is true. If the international community can't decide where to place its money, it usually buys US dollars. Now, there are data that spans from 1990 to 2022, so we can predict the future of the stock market with reasonable accuracy. Depends on what happens to the dollar today and the market. We found three possible outcomes, and they're all interesting. The chart may appear difficult at first glance, but dark blue lines show that what happens to profits when the value of the dollar rises, and the green lines show what happens to profits when the value of the dollar falls. What this graph shows then is that the stock market will have below average performance if the dollar, which is quite costly right now, remains unchanged. It won't necessarily collapse, but it won't grow either. If the dollar were to strengthen, as is widely anticipated given that the federal funds rate is likely to rise to 4.5%, bond rates would rise, luring more investors to put their money into dollars, and so strengthening the dollar. And if that does occur, the average earning report will be 7% below normal when compared to the preceding 30 years of data. Now, if the dollar weakens, something that is not expected to happen, the stock market and profit reports will be 7% above normal. In other words, how does this function properly? Foreign market sales are what makes this model viable. That's a fancy term for products sold outside of the country. Interestingly enough, non-domestic sales account for 35 to 40% of revenues for companies in the SP 500. The best way to see this is as US-based corporations selling goods abroad. If you sell goods in that country and convert them back to US dollars, you will receive fewer US dollars in exchange for the same number of goods. A strong dollar makes imports cheaper, which helps keep inflation low, but this comes with the horrible irony that it makes imports more expensive for us. Funny thing is, as investors, we want dollar to be lower so that our profits from currency conversions will be larger, and they fare better financially for the time being. However, this just means that any news reports of a strengthening dollar indicate an impending financial catastrophe and thus poorer performance in the stock market. And that concludes our video for today. What do you think about the dollar's value in the stock market right now? Do you think it's really that disturbing or not? Let us know your thoughts in the comment section below. Thanks again for watching this video, and before you leave, please make sure to give this video a like and hit the bell button and subscribe while you're at it. Once again, this is Investing Path. Thanks for watching, and we'll see you on our next uploads.